Welcome to our stock market tutorial series. Today we're diving into a fundamental distinction in finance: investing versus speculating. Understanding this difference is crucial for building lasting wealth. While both investors and speculators aim to profit in the markets, their approach, time horizon, and fundamental risk tolerance couldn't be more different. The core difference between investing and speculating lies in one key factor: the level of risk undertaken in the transaction. This risk determines everything from the expected return to the time commitment. Whenever you spend money expecting a profit based on reasonable judgment and thorough investigation, you are investing. When that decision is based primarily on chance or uncontrollable external forces, you are speculating. Let's begin by clearly defining what professional investing is and why it's considered the foundational path to financial security. Investing involves the buying and holding of assets for the long term. To qualify as a long-term holding for tax purposes, you must own the asset for at least 1 year. The goal of an investor is to generate a satisfactory return on capital while taking on an average or below average amount of risk, relying on fundamentals and careful analysis. Now, let's look at one of the most accessible and effective tools for long-term investors: exchange-traded funds, or ETFs. ETFs like SPY, which tracks the S&P 500, or VTI, which tracks the total US stock market, allow you to instantly diversify across hundreds or thousands of stable companies. A major advantage of modern ETFs is accessibility. Many brokerages allow purchasing fractional shares and support dollar-cost averaging, making long-term investing easier than ever. Another powerful tool, often used in retirement accounts, is the traditional index mutual fund. A prime example is VTSAX, a low-cost mutual fund that essentially functions the same as an ETF like VTI, giving you exposure to the entire US market. A key difference is that index mutual funds, like VTSAX, often require a higher minimum investment to start, usually around $3,000. Investing is not a sprint, it's a marathon. Your time horizon should align with your long-term financial goals. True investing is planned for decades, typically 20 to 40 years, allowing compounding interest to work its magic and overcome short-term market fluctuations. This approach is about building generational wealth, creating a strong foundation and a legacy for your children, rather than just quick wins. Now let's contrast this with speculating, which carries a much higher probability of failure and is fundamentally riskier. Speculating involves putting money into endeavors with a high probability of failure, seeking abnormally high returns from quick bets that can swing wildly. Speculative traders often utilize complex and high-risk strategies like trading futures, options, or short selling, where the success depends heavily on timing and external factors. Ultimately, the difference is a mindset shift from high-stakes gambling to methodical, fundamental wealth creation. Investing is about building a secure future based on company fundamentals and economic trends. It means setting your plan and avoiding the temptation to watch the market daily. Thank you for joining us. We encourage you to start your long-term investment journey today and focus on building wealth responsibly.